And a very good afternoon to you, and welcome to the Horowitz & Company pop-up Q&A webinar for November 9th, 2020. Well, there's no shortage of news. I mean, we can say that kind of in all seriousness. Welcome, everybody, and thanks for joining in today. I'm Andrew Horowitz, and I am the president and founder of Horowitz & Company. What we're doing today is talking about some of the things that happened in the past over the last week or so and what's happening, what we think we're going to see over the next week or so till we meet again on the Monday at 4:30 in the afternoon. Hopefully you had a great weekend. We had a bit of, well, more than a bit. We had a torrential downpour here. We had that tropical storm. We had winds exceeding 50, 60 miles an hour. And knock wood, no power was lost, no leaks in the roof, in the office, at the house. Everybody they know is safe, so everything is good. And we get through yesterday, and the weekend was relatively quiet in terms of news. And then, of course, we are continuing with the question of whether or not we do have a new president elected or whether we're going to see some lawsuits that are going to recount votes, and it's all up in the air. But as we come into the new day, stock market is doing pretty well, and there's some reasons for that. We talked about that last week. We'll talk about that some more. But the news of the election driving things higher. And then at about 7 a.m. this morning, an announcement on a vaccine. Pfizer and their partner BioNTech from Germany has come out with an announcement that they have a vaccine that they've been testing in a broad-based, large-scale environment that has a 90% efficacy. 90%, which is amazing. The hope was that somewhere over 50% would really be the threshold to, get into the system. And once that happened, you got enough people that will be vaccinated against this COVID-19. And from there, we have less of a spread, less of a disease, less of a problem, just like we have kind of with flu season. But 90% was the number, over 90%, they said, which is amazing. That's nearing eradication of this illness. So we still have some time to ensure that this will work, and there needs to be a plan for logistics and everything that's involved with the deployment, but 90% is a pretty incredible number. That's where we started the morning. Before we go any further, I want to mention that the information we talk about here today is not a recommendation to buy or selling a security. It is not anything more than educational discussion that we're having. And obviously, I want to mention to you that we have the opportunity, and that's what this is all about, is a safe time to answer any questions that you have that are on your mind regarding money, finance, investments, the economy, or anything else related to that. But we're going to talk about that in general terms, obviously, due to the fact that we are doing this in a webinar format. But please do me a favor. If you have some questions, you want something to be answered, or at least we'll try our best to answer, go over to the Q&A panel right there in the bottom, and you can ask your question. Start loading those up so that when we get to that point, after we go through the basics of the opening here, we'll get right to those. So don't be shy. Ask anything that you want. All right, getting past the important things there. What we saw today was, I would say, a very good market and a very bad market. If we can average that, that would be great. However, the situation that we're seeing right here, that we saw this surprise announcement of a vaccine, tied to the fact that the potential for a House divided. In other words, the Senate and the House of Representatives are being run by different parties, thereby creating some roadblocks to legislation, or not the blue wave that everybody was really concerned about. That's the big issue. What's been driving markets higher recently is the idea that, hey, we have a new president. Biden was supposed to be really bad for the markets with the tax increases, the re-regulations, all the things that would be really problematic from the aspect of what the campaign was all based upon. Tax the rich, go after the companies, and all of that. And markets were very concerned about that. Meanwhile, what happens? At least at this point, we see Biden and Harris win the election and markets go up, which is kind of counterintuitive. So what you have is a situation that really is not necessarily based on that. We talked about that over the last couple of weeks in the podcast, the Disciplined Investor podcast. I think we talked about that last week here, and I'm just going to touch on it for a second, is that we have this divided government right now where there is a potential stoppage of any runaway legislation that would happen if we had a blue wave come in, or a red wave, whichever way you want to look at it. Whereas a legislation would be crafted, passed, signed off on, put into law very easily. Right now, probability is that the Senate is going to stay Republican controlled. That being the case, well, that means that any legislation that's put up that they don't like, they can pretty much just stop. Now, executive orders are a different story, but if we're talking about taxation, that has to run through the full Congress and get approval by the president. So everybody has to agree upon it. Now that we don't have that situation where there is the Republicans that may say, oh, no, we're not raising taxes. What you may see is a situation where that part of his campaign platform is not going to be instituted. Therefore, stocks are happy. Investors are glorious. They're saying, hey, this is fantastic. We don't have to worry about the increase in capital gains taxes, that whole issue right there, the increase of corporate tax from 21% to 28%. We don't have to worry about that and cutting back on earnings and cutting down earnings. We don't have to worry about the estate taxes, at least right now. So that's where that jubilation has come into play. Now, this morning when we wake up, we find out that there's a vaccine that is somewhere into the future, but better find out that it's sooner than later. So we're finding out that it's there. Well, what happens is the entire market is turned on its head. What was working is not. What wasn't working is. What was working before, of course, was what? The stay-at-home trades, the Zoom medias, right? The technology companies, the Netflixes of the world, all the things that were kind of like DocuSign, all the things that were, okay, I'm going to buy more furniture. I'm going to buy it from Wayfair to make an in-house office or an office in my house. All these things that were out there that were doing really well and just continue to get money attracted to them, all of a sudden collapsed today because the thought is, well, you know what? Wait a minute. We can go back out. If we get this vaccine in, what the good news is on that is that we can actually go and do different things and not just stay home and be under self-quarantine, or we don't have to worry as much that there's going to be governmentally imposed lockdowns, stay-at-home orders, because this thing is in the ninth inning. Kind of that's what we woke up to this morning. Immediately, markets rallied. Dow Jones futures this morning were up 1,700 points. We saw that the small caps were just rocking out. We saw things like banks, et cetera, going crazy. On the other hand, Nasdaq lagging a little bit, but still doing okay. The entirety of the investment universe was just moving up incredibly. The winners, things like hotels and casinos, cruise lines, banks, travel, small caps, as I mentioned, incredible moves. Peloton, large growth, Nasdaq, stay-at-home names getting crashed. Again, movie theaters doing really well. The mall operators having a great day. Large outsized moves. The U.S. dollar, which has been in a downtrend for a period of time, big up day. Bond yields moved higher. The 10-year over 9.5% midday. I think it closed closer to 0.9 and change. That's a big move from where it's been. Precious metals were down. Energy was up. Again, a total flip-flop of what we saw. And what's interesting is when you see something like this in the past, well, we haven't seen it as pronounced as we saw today, but usually it was short-lived. But now that we have a vaccine, it opens up an entire new universe of discussion. And the discussion that we really need to be focusing on, I think that hit like a sledgehammer on the foot of the markets today, was what does this mean for stimulus? Because remember something, over the last several months, what has the market really been moving on? It's been moving on the idea of the big cap names will be moving due to stimulus, low taxes, et cetera. But it's all about the stimulus. That has been the biggest issue and the direction of the pandemic. Usually what we found is the worse that the pandemic got, the more the potential for stimulus. The more that we have an inclination of governments to shut down, the more they needed to replace that particular income with stimulus. And as such, markets were just thrilled. They were giddy. And we kept on putting money into names like you heard of, like Microsofts and the Apples and the Netflix and the Pelotons and the Zoom. All these stocks did incredibly, incredibly well. So now, when we all of a sudden change the narrative to a situation that may get back to normal, well, wait a minute, what was it that we did before? What was it before we saw this that really was doing well? And what could go back to doing well? When you see outsized gains in cruise lines, like 35% up for the day, banks up 8% for the day, you wonder, well, if things are getting better on their own due to the fact that we have this vaccine, do we need as much stimulus? And last week, Mitch McConnell was talking about putting forth a skinny deal, a skinny proposal, which would be very targeted to where the stimulus would go, which is probably at this point the right thing to do. We don't need stimulus being just thrown out there, and that was just incredible amounts of fraud and misuse that was from the last $2 trillion package. But if we can get back and we can see that things are opening up and we don't have to shut down as much, there are areas in the economy that still need a lot of support, and maybe direct it specifically to those. And therefore the market is saying, wow, you know what? Good news. Good news. These companies that we thought were going to go bankrupt or have major problems, hey, maybe they're not going to do that because we have this vaccine. However, what about the fact that maybe stimulus isn't as necessary anymore? Yeah, we know that the Fed will keep rates down. They're going to hold them down for a while. But what if stimulus isn't needed as much as it was, and what's going to be a hard press to sell through the entire system? So with the skinny deal, it's puts a big question mark into the free money plan that was out there for some time. And many of those companies that were trading at multiples that were just absurd, and those companies were trading at multiples that were on the low side, absurd, flipped. So what markets seemed to like today was the idea that, you know what, many of these companies that have been overlooked, that were the old school, the old world of value plays, hey man, let's get in on those now, because you know what, these cruise ships can start cruising, and there's a vaccine. Listen, if there's a vaccine, this cruise thing is, and this pandemic is over, I don't know about you, but I'd go on a cruise if we can get through this and it really was over. I'd go on 2 cruises, maybe 3. I'd go out and party again and do my thing, right? I'd travel and do all the things that were concerning. So right now, there is a combination of, hey, let me just restate the point. We have roadblocks and problems with getting any kind of major legislation done. That's good because we don't want the tax increases and the concerning areas of re-regulation. That's what the markets are saying. That's what they're saying. However, they're also saying, you know what? And now the better news, we have a vaccine potentially, and that may get us all back to work and everything back to normal. And they're finally saying, but wait a second, we still want that, you know, that ice cream on the top, the cherry on the top of the ice cream. We want our stimulus. And if you're not going to give it to us, hey man, certain areas are not going to do so well. Now, let me kind of take you through a couple things. I have some charts to show you, and I thought it's kind of interesting, and I want to show you what happened today. This is the Dow Jones Industrial Average, represented by the DIA, which is the ETF that represents the Dow Jones Industrial Average, up about 3% today. Really nice day overall. We see that incredible pop off the open. I mean, that just ramp up the open. That was 1,700 points. Finished up about 3% today, but it was up 5% sometime during the day. We saw a bit of a drop on the end when reality hit a little bit, and when Mitch McConnell came out and said, you know what, we are supporting President Trump in his efforts to, you know, do the lawsuits and recounts and all that, because we do not recognize President Biden as the president-elect right now. We think there was fraud. We think there's problems. So we're still going through that. However, the other thing is, I think the recognition of, oh, you know what? Hey, wait a second. This is all really good news, although it may take some time to get this all done. We may see some lockdowns again. That could be happening because maybe until this vaccine is done, there are certain parties in or players, I should not say, not parties, players out there, like we saw Newsom today in California talk about further restrictions. We see New Jersey say, hey, we are locking down restaurants after 10 o'clock tonight. We saw El Paso last week. We're seeing an incredible surge of this. So maybe they'll be more inclined to shut down with the knowledge there is an imminent vaccine in the next 2-3 months that can happen, and then we can get beyond it. Therefore, slowing the spread now, and I think that's on the mind of some investors right now and what we're seeing. But I think this last tick here was, hey, we're not really going to get the stimulus that we think we're going to get. We may get further lockdowns until the day that we get the vaccine. And, oh, wait a minute, maybe Biden's not the guy. And finally, we still don't know the answer in the Senate. It's not fully flushed out of what the control of the Senate is going to be. I think there's a few more races that have to play out here. So that's an issue that is kind of concerning also. This is the S&P 500, finished up only, and I say that seriously, only 1.28% today. That was up almost 5% at one point today. So we saw this mad rush to 362, down 10 points on here. So finished below the 3,600 level on the real S&P. This is, again, the S&P 500 ETF throughout the day. But it gets more interesting. Here's the Nasdaq. This is what I'm talking about. The Nasdaq got eviscerated today, down over 2%. Now, what's interesting about this is it was up about 2% at one point during the day. That was a 4% turn on the Nasdaq. So again, just to restate and refresh here, we saw that the Dow Jones did very well, down off its highs, but did very well. The S&P 500 did okay, did pretty good, not as great as it was for the day. The Nasdaq turned tail, okay, but this is the iShares Russell 2000. This is a small cap index. Now, what's really interesting about this is you see that the small cap index was up 3.88% today. Well, there's two sides that we look at on the Russell. We look at and the large caps and the mid caps. We look at the large cap growth. We look at the large cap value. It splits the total the total number of stocks in half, and it looks at which ones are more value, which ones are more growth, which ones are being priced on kind of a different basis that looks for growth of earnings over the future, et cetera. One's kind of more your banks, one's kind of more your technology, one's your healthcare, that's the growth, one's your staples and maybe utilities and real estate. Well, what's interesting was today that we saw that while the Russell 2000 was up 3.8%, which is a good day. It was up about 6.5% at one point today. What's really interesting to note is that the value side did so much better. I mean, so much better. In fact, the large cap growth side of the equation, which is the Russell 1000, so the S&P will call it, like the S&P 500, value side was up like 5%, or 4% at the end of the day, where the growth side was down 1% for the day. Now, moving a little bit further to show you this. Look at this. This is the financials today. When's the last time you remember seeing financials do as well as this? Where'd that go? Hey, where'd it go? Here we go. Yep. Oh, there we are. The financials up 8.5% for the day. Pretty much not only held on to its opening bid, climbed throughout the day, and pretty much held up there throughout the whole day. Financials did well. Leisure stocks, airline stocks, all ramping incredibly higher for the day. And then you have to ask the question, well, is that just a couple day wonder, or is that something that's going to actually play out and do well? Again, direction of the virus, direction of what is going on with the markets right now. The vaccine is a big, big issue here. And this is that rip your face off rally that everybody talked about once a vaccine was going to become available. But it's very, very lopsided. It's hurting the biggest cap names in the market, those names that really pulled up the entire market for a period of time and really helped all the stocks underneath it, which is also very interesting. One of the reasons small caps did so well today was because the banks did well. The regional banks were just on fire. I mean, incredible, incredible numbers today. And what's interesting about that is that when you saw that there was this rally in the banks, well, the small caps followed, and that was the value side. The small cap universe is really packed full of regional banks and energy shares, both which did really well today. So that value side really outperformed substantially, and again, the other side, the growth side, the tech names, the healthcare names, not some of them did well, but not well overall. Biogen got plunged. Some of the other names that weren't affiliated and associated with the COVID vaccine potential. But you had companies like the AstraZenecas and Gilead and some of the other names like Johnson & Johnson, Moderna that were doing well today as the virus vaccine was found and there was hope for other ones to come up with this. So kind of an interesting situation and backdrop for what's happening right now. All right, with that, let's start with our Q&A and get into this. Let me get that queued up. And we can then... Anybody can ask any questions they want, by the way. Just kind of ask them. We have about 5 or 6 questions. They usually build, but do me a favor. Ask those questions right now, whatever you want to ask, whether about stocks or gold, metals, the dollar, I don't know, commodities, the election results, what's happening here, some of the pharmaceuticals. We'll do our best to answer those. First question comes in. Hey, Andrew, when you wake up to a big gap up day like today, how should you generally react? Buy, sell, or just wait it out for a few days to see where it goes? Well, again, this is a very news-driven tape right now. The markets are just, they're trading thin. There was a lot of volume today, but they've generally been trading kind of on a thin tape basis where any news just makes it fly all over the place. Generally speaking, what do you do on a day like this? Well, it depends on how you're set up. I mean, if you're in a day like today, if in fact it is true, and if in fact there is going to be a vaccine, I mean, you want to start rethinking your positioning, because if we are going to see that whole stay-at-home trade just disappear, and companies like Zoom will do well, but yet not the same level, a Peloton, questionable, a Wayfair, questionable, but yet there is some opportunity for the bank. So if you waited incorrectly through this whole correctly up until today, up until last week, where you had a big part of your portfolio being growth, and you wake up today and you're like, see this, and things are good, but yet by the end of the day, you see that it all faded out to a degree, and even your growth names got your portfolio looking pretty ugly. I would venture to say that a lot of portfolios, even though the Dow is up substantially today, were actually down today. If you were not weighted properly, or even if you were balanced a bit today, you probably didn't have the best day. You had to be more towards the value side. You had to be more towards real estate. You had to have very short bonds. If you didn't have a setup that was correct, I mean, it could have been a really ugly day overall, because there was a lot of red on the tape today. I would say that you wait out a few days and see what happens. Generally speaking, if you are repositioned, if you were short-term, maybe hedged out like we were this morning on some of the small caps, where we closed that position early morning, and we kind of just waiting to see what happens otherwise, to see how things play out. Some stocks could come up to be a buy in this if, for whatever reason, there is a reality check that goes on, something happens in the process of getting this drug out, doesn't work as much, realizing that maybe, hey, you know what? Not everybody's going to take a fast-track vaccine like this. There's concern. They don't want to be the guinea pigs. That is something also. But when you see this kind of situation based on news, usually kind of wait it out and kind of catch your breath and then make some moves. Good question. Mike has the next question. Hey, Andrew, I've been watching aerospace area like ITA, which has been relatively on fire. I want to know if this is a short play or possibly a longer play. So the transports, I mean, in theory, if we have what we saw like today, and a big part of that's Boeing, by the way, and Boeing started to do a lot better when the earnings came out, and we saw that the 737 MAX was back in play. And I think that what you have here is a real recovery play potential. And if things go well in the recovery, there's a great opportunity. They'll probably get overdone pretty quickly, because that's how markets react. They're fast. The rotation today was wicked. And it could take 2 days and just turn around again. But, the transport area, and especially the aerospace, it may really have a great opportunity, because if people get to be flying again, don't forget, these companies got really lean and mean. This is one of the benefits of these horrible situations. When you get into a dire situation, like we've seen from many of the companies that are related to the leisure travel industry, what they do is they get lean. They make sure that they have cut the fat. And by cutting the fat, when things come back, they could really do very well. That's the beautiful thing about markets. There's a lot of fat that gets accumulated, and then when they cut the fat, things are possibly really bad. But when it does start back up again, they're a lean, mean fighting machine and really have an opportunity. So keep a watch on. I think you're on the right track there. Okay, another question. Markets have been up huge this last week and especially today. I took profits in several stocks as they were up significantly. However, I do notice that these stocks are still low compared to last year, and I'm concerned that I won't be able to get back in this price level again. When to transition out of transition out of 1 foot in, 1 foot out mode? So I'm not sure. I mean, taking a profit's never a problem, right? I mean, that's always something to give yourself a pat on the back on. I think that's okay to do. I don't have any problem with that. When do we get out of this 1 foot in, 1 foot out mode? I mean, there's a couple of things that are involved here. One thing is that if you're in this mode where you're kind of in, you're not in, it's because you're concerned about where the direction of the market's going to be with the uncertainty that lies ahead. So when that uncertainty collapses and we have less problems and worry about what the future is going to look back, that's when you kind of start thinking about, okay, maybe I'll change that around. Now, there's a lot of things that you can add into that concern pile. Let's start with, okay, well, we got a pandemic. All right, that's a big issue. We kind of can push that down a little bit right now while we are seeing it rage out of control around the world. But, we have vaccines. So that's kind of a little bit of a check mark in that box. Not a big one. The election's over. Okay, a big issue, the big concern. We're going to have a blue wave, higher taxes. It's not exactly there yet, but it's getting there. So we can have like 1 foot in, 2 toes in at this point, right? That's where we should be going in theory, right? The next thing, okay, well, what's happening with valuations? Well, that's a big concern. That kind of gets you like, maybe we're a little bit out of whack here on some of these valuations. Do we necessarily need to see that a particular event happens where the stock market's declined to a point that it makes it reasonable to get back in, or do we have to see that valuations catch up? So you got that issue as well. So you got that. Then you have the rest of the general everyday concerns that are out there about markets being thin and not trading right, or hey, you know what? The future is very bright, depending on how you want to look at it. I would say that right now we're still in a questionable area. It's still a lot of concern. The VIX is still, even though it's down, it's still in the 24 or 23 range. It's still elevated. We're still not at the end of the election. We still don't know what Biden's going to do. We still don't know what's going to happen exactly with his vaccine. So we're kind of still in there a little bit. It also depends on how long you have to go. If you have a time horizon of just 3 years, there's nothing wrong staying 1 foot in, 1 foot out. Again, when I say out, that means just cutting down exposure and redeploying into other areas. That also means not necessarily being all equity or all bond or all real estate or all gold, but being diversified properly. Because even if you have a reduced exposure overall, you still can catch some really good gains if you're properly allocated. We talked about like having a higher level of emerging markets, possibly a higher level of value. Right now, our value play looks great. Last 5-6 days, it looks fantastic. But it really didn't look so good over the last 6 months. So I think you could slowly but surely get back in. But I think there's a difference, and I'll finish with this. I think there's a difference about the idea of taking some profits out. And by the way, when you take profits, you don't necessarily have to take the full position out. But you could also find where there's other opportunities to put it as you're doing it. So if you are thinking about pulling the money out, you could say to yourself, well, okay, if I'm going to pull the money out, I want to make sure I have somewhere else to put it. Where is it going to be before I make that decision? So not just in cash. Next question, Andrew, how do you see consumer discretionary such as VCR and iBuy for longer positions? Or do I buy more for a position in your portfolio for a longer? Okay, Andrew, how do you see consumer discretionaries? Okay, a couple of symbols there. For a longer position or buy more for a larger position in your portfolio. I mean, consumer discretionary has done extraordinarily well, generally speaking, this year. A lot of it is because of the way that things have gone. Again, they've leaned up. They're sending things rather than in store. I mean, some haven't done well, but Macy's and Kohl's and Dillard's and the big boxes. But yeah, look at your Best Buys, look at your Amazons, look at some of the other names out there. Consumer discretionary is a good place to be. It's cyclical. It all depends on the economic environment, the amount of money people have to spend, the overall confidence out there. You would expect that with a vaccine, confidence will go up. There'll probably be a really big relief a relief buy where people are like, oh, I'm going out, I can finally spend money if they get jobs. Now we saw that the jobs number last week went from 7.9% down to 6.9%. There was a statistical anomaly with that. I don't necessarily believe that was the real number. There's still a lot more people out of work, but there was that situation. I think that is part of your portfolio. I never like to overweight consumer discretionary. I just don't think it's necessary. I think there's other ways to play it and broad base it within the portfolio. But I don't have a real problem with having that as long as if consumer discretionary can do well in this environment, it could do well in a better environment. And how much worse is things going to get over time? The only issue you have to look at is the issue of stimulus. If there is no stimulus or a very reduced package, that's going to be a problem for the consumer discretionary names. Next question. Ron says, what do you think about the continued rotation into value stocks? I mean, I like it. We've been unfortunately a bit over just a slant into value on our large cap base, on our domestic equity base. We've been slanted slightly over to large cap. I have no objection to that. I still think you need to be relatively somewhere a little bit to the left, a little bit to the right of center, because you never know exactly what's going to play out. I would not have thought that during an economic slowdown, as we've seen with the big stimulus package that we saw, that we would have seen such extraordinary divergence in value and growth. The biggest we've ever seen, I think, on record, as a matter of fact. A lot of catching up to do on the value trade. It could be really significant. Next question. So Andrew, how about adding to gold, silver now? So one of the things we did last week, throughout the week, and we've been working on for a while now, has been to start to slowly but surely rotate our commodity basket to not exclusively, but primarily gold and silver, rather than the ags, the livestocks, the energies, the precious metals, and the industrial metals. One of the things that we have a concern about is that even if demand comes back somewhat, and I know that oil spiked today a bit, about 8%, on the thought that there will be a lot more usage due to the fact that we got a vaccine. But at the same time, there still is a bit of supply overload. The only thing that's really holding down demand right now is OPEC, and they're suffering dramatically, and they're holding back that to a point where it's still not enough, and we're seeing extreme oversupply in the sector or within that commodity. And I think that the higher prices go, there's a natural cap to that, because once you start seeing prices go higher, the gases go higher at the pump. And a lot of the people who bought large trucks and SUVs over the last couple of years, and particularly over the last 6-7 months, with the advent of electric vehicles, or EVs as they're called, there may be a continuation of the push towards EVs. As we see that happen, less demand for fuel, higher prices, more demand for EVs. And as we have legislation that goes on to create a greener earth, there's going to be more and more incentive for EV EV manufacturers, probably from government grants and tax credits. So I think that has a natural cap on oil demand. More so, the bigger problem is there's oversupply, and that oil demand is only going to be changed due to the fact of any kind of changes of OPEC output. And therefore, when you have that OPEC output, that's the only issue of that, you realize that there's a lot more in the ground, and people are not going to pay up for it. So bottom line to that point, and the summation of that, is that we are rotating more towards gold and silver, and we think that has a better opportunity, especially of the fact that if you really think about it, if we get a vaccine now, especially with all of this stimulus that's flooded into the system, and the Fed that says, you know what, we're going to let inflation run hot. We're going to keep our rates as low as possible. Countries around the world continuing to flood the QE, the low interest rates. Inflation is, I don't see anything but an absolute that's going to be here, and it's going to start picking up. It may not be rampant runaway inflation that goes to 5% overnight, but I got to tell you, I don't see any real reason, except for some technology enhancements and innovations that may be holding back some of that. But right now, given all the things that we know with the potential spending that's on the horizon, the continuation of stimulus, maybe a vaccine, I can't imagine a world that we don't see inflation really picking up substantially. All right, we got some room for a couple more questions. If you do want to ask, like I said, don't be shy. Ask anything you want. Plenty of people here that can ask questions. And I know that many of you have them, but don't be shy. Don't be whatever it is. However, if you don't think it's that important, or you may think that people, oh, what are they? Nobody knows who you are. I'm using your first names. Nobody knows who you are. So just ask the question. All right, let me kind of scroll down here. Another question about commodities here from Aaron. Question about commodities. I'm in the silver ETF, and with the US dollar sinking, what do you think about gold and silver? A couple things. Well, the dollar did come up today pretty good, about 2% up, or 1.8% up against the yen, and it was up against other major indices, obviously, on this risking trade of the markets and a risk-on trade that we saw substantially today. However, still have to know that there is a lot of spending that wants to be done, whether it's stimulus directly or it's an infrastructure plan. I don't necessarily know how long the dollar could move higher, considering a few of the things that we do know about the backdrop of the economy as well as the rest of the world. And, you may look at this as an interesting situation that the dollar got stronger due to this vaccine, but you would think that it should be still a risk-off trade. And with the idea that there is more to go potentially for the downside of the dollar, again, the trend has been down. I still think that gold and silver are an interesting play. Quan asked a question. When analyzing a stock chart, I hear that it's important to look at daily volume versus average volume. I try to do this, but I can never make any correlation with the volume action. How important is volume analysis in your book, Andrew? So I don't know who says that average daily volume is not important. What I look at is the daily volume compared to the average daily volume. Maybe that's what should be looked at. What they're saying you should look at. So let me restate this. When you're looking at a volume chart, it's very one-dimensional, and that's why one of the things that we have is a tool that we built called it's a tool that combines volume and price, and it gives us a little bit of a better understanding of where things are. But by using volume on a chart and looking at the daily volume, I think that that's fine. But what does it tell you? Now, it may tell you, well, volume was higher today than it was yesterday. Well, how much volume is higher? I mean, is it a lot higher? And what does that mean? So if you use, for example, a 30-day average volume on a stock and see if the stock was up or down, dependent on where the volume is. In other words, stock is down heavy. How is the volume compared to the 30-day average volume? That takes into consideration a lot of different scenarios, a lot of ups, a lot of downs. What if the stock is up over the last couple of days? Well, how much more than the average daily volume? Because that can give you an inkling and an insight into who's buying. If we see a big move about 100% higher than average daily volume of the last 30 days, we can say, you know what? There's a lot of people putting their money into work here. It's not just moving with the markets. There's a lot more interest in the stock. So what I would recommend you do is that you would go and utilize the combination of something like an average daily volume over 30 days and overlay the daily volume and see where it compares to that. Use both. I think that's the way you want to play it. Question, Andrew, what do you think of Berkshire's value, noting the repurchase of shares at a price up to $215? Yeah, they bought back like $9.5 billion worth of shares. Their earnings were actually not good at all. And most of their benefit came from their holdings in Apple stock. That's what really did it for them last quarter. They are breaking their rules by doing some of the things they're doing with their share buybacks, but yet they're seeing value there, nowhere else somehow. Value there, but nowhere else. And they may be right. I mean, the truth of the matter is that a lot of the companies that they have inside their portfolios, like Precision Castparts and a few others, aside from Apple, are very much concentrated into and aligned with the economic activity of the world in the U.S. So what happened was that obviously they're not doing very well on some of them. And their earnings weren't good, and showed that over the weekend when they came out with those results, that things aren't as good as they could be for Berkshire. I'm not a big fan of owning Berkshire necessarily. I think it's just a big giant conglomerate, which is fine. It's like owning a mutual fund. If you own it for a let's call it a staples slash consumer discretionary, I guess that would be the one, and some technology, or just a big basket, that's fine. But realize that a lot of their benefit will come in the years to come if they can make their earnings and do a little bit better by the fact they bought back their shares and goosed their earnings by doing so, by having less shares on the open market and having the same, less or more earnings converts into a higher per share value, which is what everybody looks at, even though Warren Buffett himself said that's not his preferred metric of what to look at. All right, last question coming in. Anthony asks, I understand Disney had a huge move because of the vaccine news today, but how did it hold on for so long? How did it hold on for so long? Just 15 to 20% off its pre-COVID top. What did Wall Street see in them? I'm not exactly sure I understand this question, but how did it hold on for so long? 15% off its. I think that the idea of Disney Plus was a big issue with Disney. I think that there was the understanding that parks were going to reopen, plus that, eventually sports were going to come back and ESPN could be there. That was a big issue. It was a sports franchise, which is a problem for them. Disney Plus was a big issue. They were entering in there and then kept on spitting out really great numbers in terms of the people that were subscribing to Disney Plus. You would think that they lost some of that today, but yet today was also a good day for the parks. It was also a good day for sports for them. So it was a totality of their franchises, I believe, that was really exciting about what happened today. And I think that, Disney is one of those that pays a high dividend. Everyone loves. They have a great franchise in terms of their arsenal of content, the way they're distributing it, the potential for the parks to reopen back up, and the sports. And you sprinkle that together and you realize that eventually, once this kind of gets around, there's going to be, again, a big amount of, people are going to be pent up and the demand has to be released, right? So I think that was the big issue in that. All right, last question. Carl asks, Andrew, for trading, should one look for stocks with high short interest after a day like today? Well, first of all, short interest only comes out every 2 weeks, so it's really hard to tell what the short interest is on a particular stock today versus it was yesterday. I do believe a lot of the short interest stocks that were heavily shorted, obviously, that we know got a big pop today. I mean, just look at that move on Macy's, one of the biggest shorted stocks out there, got a big move. Actually, you want to start looking at those stocks that have been moving higher with low short interest on a day like today, because then they possibly build back that selling pressure on them. Don't forget that one of the aspects of short interest, when you have a high short interest, they have the potential of getting ricocheted the wrong way because the shorts have to cover into a significant amount of buying pressure. And then once the shorts cover, they create more buying pressure, which then makes more shorts cover. So I would kind of look for both sides right now. Look for those stocks that haven't seen the appreciation of others, and watch for to see if there's going to be over the next few days, if there's going to be just a one-day wonder here or a two-day wonder, or if there really is some legs to what's going on, and then you can, kind of bite into that. The problem with these markets are you wake up in the morning, it's up 3-4%. You can't do anything for most traders until it opens. It fades out, stays where it is. Next day is a whole new story. Stocks up 20% off the bat. What do you do with that? You try to fade it, you try to trade it, you want it in, you can't get in. I mean, everything happens almost pre-market right now, and the rest of the day is just nothing happens. So it's kind of, for a trader, it's a very difficult environment if you're in and out during the day. And if you're scalping, it's one thing, swing trading another thing. But trying to gauge what is going to happen one day to the other with this incredible amount of news flow is you don't know any time during the day what's going to happen, how it's going to break. So it makes it a little bit tough, but it can be done. Anyway, thank you very much for joining me. We're going to cut it right there. We'll see you again next week, tomorrow night at 9 o'clock live. Myself, John C. Dvorak, will be talking on the DH Unplugged podcast, of course, and much more to come. Thank you so much for joining me. This will be recorded. This will be available on the disciplinedinvestor.com website tomorrow. So if you want to re-listen to it, and make sure to tell your friends, your family. Thank you so much for joining me. I'll see you soon.